Hello everyone, today is Thursday and my name is Salvatore DiCostanzo. I'm an elder law attorney and estate planning attorney here in Westchester County with offices in Rye and Yorktown Heights, New York. I almost forgot where my office was. And it's good to see everybody today again remotely, even though I can't see you. But we've been doing these weekly informative chats, if you would, on various topics and inviting special guests on a frequent basis. And it's been very useful to a lot of people out there, and I'm glad to hear that people are enjoying these. I've gotten a lot of feedback, a lot of emails from people saying that it's helping them educate themselves and make decisions about their estate planning. And so we're continuing this. And today I have a special guest and a friend of mine, a good friend of mine for many years, Chuck Newman. Chuck,
thanks for having me.
Nice to have you. And we're going to talk today about long-term care insurance options. Chuck, one of the things that I say to people when they come to my office and we talk about planning for long-term care is that I say to people, you really only have limited options when it comes to planning for your long-term care. And as an elder law attorney, we have certain arrows in our quiver, if you would. But I tell people, and this is very important for you to understand, there are limited options when it comes to planning for long-term care. You can privately pay for your care, right? That's option one. But we all know privately paying for your care can be quite expensive.
Sounds like the exact same conversation I had. Exact same.
And so, a nursing home today in Westchester County might be about $15,000 a month.
Sure.
And home care could be $10,000 a month. Depends on what your needs are.
Absolutely. Yes.
So it could get pretty expensive. You multiply that over the time period that somebody might need the care, and you could really exhaust a lot of resources. So option one is to pay for it yourself. Option two is long-term care insurance, which we'll talk about today. Chuck is, am I allowed to call you an expert?
Legally? I'm not sure.
Yeah,
but
okay.
I've only done it for about 30 years.
Chuck is very well versed in this area. So he's going to talk to us today about different options. The long-term care insurance field has changed, has gone through a metamorphosis over the last 15 years. And so we're going to talk a little bit about that. We're going to talk a lot about that. The third option is Medicare. Now, a lot of people don't realize that Medicare, it's not really an option, right?
It isn't. I mean, Medicare is really meant to pay for doctor, physician care, nurse care, hospitalization, but it doesn't pay for custodial care, and custodial care is what long-term care is really about.
And so Medicare only pays for, at best, 100 days in a nursing home situation.
Coming out of the hospital, right?
Yeah, and you have to be in the hospital. You have to have a 3-night hospital stay.
Correct.
Otherwise, Medicare is not going to pay. And so a lot of people come to me, and we're sitting here, and they say, but I have Medicare. That's great, but it's only 100 days at best, and they can stop paying before the 100 days.
Right. It's for skilled care. So basically, anything that doctor's office visits, your prescriptions, rehabilitative care coming out of the hospital, but not long-term custodial care, where you need simple human assistance with daily activities. That's not what Medicare covers.
That's right. And the fourth option is Medicaid, which is what we do as elder law attorneys. We do a lot of that. And Chuck and I have worked on cases before where there's a little bit of both, right? There's a little bit of long-term care insurance, and there's a little bit of Medicaid, and that's one of the things that we're going to close today talking about.
Sure.
So Medicaid is your fourth option, but in order to be eligible for Medicaid, there's planning that must be done. There's trust that might need to be set up, which we'll talk about today, and there's movement of assets, etc.
Well, that's what you're an expert in.
Well, I'm not allowed to call myself an expert. We need to address some of these rules and regulations, but I'm well versed. Let's put it that way.
That's a good way to put it.
So those are your four options for long-term care, and what it really comes down to often, if you do no planning, you're going to end up privately paying.
Right. So no plan is a plan in of itself, right?
That's right.
You're planning so that if something happens, you'll spend down your savings, you'll spend down whatever you've accumulated during your lifetime, and that's a conscious decision that a lot of people will make.
People do make that.
Absolutely. Everyone has a different idea of what gives them comfort, and some people fail to plan. Some people plan to fail.
That's right.
It's just the way it works. So I do have that same conversation. I have there really are the same options that I talk about. Don't plan, use your assets. Look at Medicaid planning with an elder law attorney, or look at insurance. And there are different aspects of the insurance that we can talk about.
So let's now talk about that. But it's important to give everybody the background, because a lot of people, when we start talking about Medicaid and long-term care, they don't understand why we're in that ballpark necessarily. So, sometimes people might say, "Oh, you're just trying to sell me long-term care insurance," or "You're an elder law attorney, and all you do is Medicaid, so that's the only option that you're giving me." So it's very important for us to educate you and give you an idea of why we're in this playing field. So, we do talk with clients on a regular basis to say, listen, before we do Medicaid planning, depending on where you are in life, and you'll go into the different circumstances, we might want to look into long-term care insurance, right? And I want you now to talk about when somebody should be considering long-term care insurance, what your options are. People, I'm sure our viewers have questions such as, is it expensive? One of the one of the changes that took place over the last 10 years had to do with the fact that the actuaries didn't necessarily put these policies together the right way years ago. So I'd like for you to give people a little bit of the background, the history over the last 10 years, because there's a little bit of a perception out there right now that long-term care insurance is too expensive, it's difficult to get, it may not pay for everything, and nobody's selling it anymore.
So there are different varieties of long-term care. When I started selling long-term care insurance in the 90s, there was one type, and that's American Express actually was the first company to come out with long-term care insurance. They had a policy that will pay a daily benefit for a defined period of time after a specific waiting period. Then there was a question as to whether that benefit inflated over time. And that was pretty much it. I call that kind of the plain vanilla, standalone, long-term care insurance policy. Still exists today. As you were saying, Sal, those policies were mispriced. The actuaries, when they priced long-term care, standalone long-term care insurance policies, based the design on disability policies. Long-term disability policies have been around for a long time. But qualifying for long-term disability and then maintaining that policy turned out to be a lot different proposition than with long-term care insurance. So what happens with long-term care insurance? Long-term care insurance, people were paying for these policies for a very long time, and they were claiming on these policies to a much higher degree than the actuaries ever anticipated. So here the insurance companies were paying a lot more in claims than they ever thought they would. There's something in insurance called the persistency ratio. How many policies actually stay on the books to the point where they pay out? That exists with disability insurance, life insurance, and long-term care insurance. Long-term care insurance is where they really misjudged. A lot of those policies that they thought would go off the books stayed on the books. People kept paying their premiums and then putting claims on them in much greater numbers than were anticipated. At the same time, we've had this prolonged low interest rate environment. So out of every insurance premium you pay, whatever it's for, life, disability, long-term care insurance, a portion of that is invested by the insurance company. That's their general assets. They invest that. They're getting much lower returns than they ever thought that they would, right? In 1992, 1991, when I first started my career, interest rates were 9 to 12%. That's what was projected forever. Now they're 1% to 3%. So the insurance companies just vastly mispriced them. So what happened is all of them went through rounds and rounds of price increases. A lot of insurance companies dropped out of the market as well. So today you've got a few long-term care insurance carriers. Mutual of Omaha is one, John Hancock is another, Transamerica is another. Travelers went out a long time ago. And you've got a lot like Genworth, which was, I used to call them the 800-pound gorilla because they had about 30% of the market. They stopped selling policies within the past 2-3 years, something like that. That doesn't mean they're not honoring their policies and honoring their claims, they're just not selling new policies. So that is the kind of the garden variety, standalone, long-term care insurance policy. What's happened is the life insurers have kind of stepped up to offer products to address this need. Now, you have to get a life insurance policy that combines with a long-term care insurance, let's call it a rider, so that if you need long-term care, you can spend down that life insurance death benefit. If you never need long-term care, there's a death benefit, just like a life insurance policy will always pay out. $500,000, $1 million, whatever you decide to purchase. Getting back to your question about premiums, that's where there's a big disparity. With standalone long-term care policies, those premiums were never guaranteed to not go up. The insurance companies always reserve the right to raise them. With a life insurance policy, however, your premiums are guaranteed.
And the premiums on the old-fashioned policies have been raised many times.
They've been raised many times. In the current policyholders or policyholders who've had those policies for a long time are still seeing increases. Just got some increases from Unum. Unum's a great name in the disability business. They stopped selling long-term care insurance policies a long time ago. They're still raising premiums, as is every other carrier on their policyholders. Excuse me. But with life insurers, you're paying a higher premium than you would for that standalone long-term care policy. But guess what? There's a guarantee it's going to pay out because 100% of us are going to die.
Right. I'm still not believing that.
So that's really where the market has gone more in the past few years.
Right.
Life insurance that has a long-term care component. And in that regard, there are a couple main variants. One is some of the carriers have come out with lump sum policies. So you take a lump sum, you've got money that's, they call it lazy money in the investment business. Money that you're in maybe CDs earning next to nothing. It's money that you won't need to invest for any type of income flow. It's just set aside. Take that money, put a lump sum into this hybrid long-term care insurance policy and life insurance policy. So if you're in your 60s and in reasonably good health, late 50s, early 60s, you take something like $100,000, put it in one-time lump sum, that immediately creates, just hypothetically, don't quote me on this, life insurance death benefit of maybe 2 to 2.5 times, so 200 to 250,000, and a long-term care benefit of up to 400,000 or something around there. So that 100,000, you leverage that to create a death benefit, which we know 100% of us will need, or a long-term care benefit if you ever need that. And by the way, 15 years on, 10 years on, you decide you don't want that policy, most of them allow you to just take it out, take your initial investment out, and call it a day.
So that's the best of both worlds, right?
It is. It is for people who have that kind of liquidity, that kind of cash available. The other option is a permanent life insurance policy. There are different types of life insurance, term and permanent. So this is not a term policy, this is permanent. Typically it's a guaranteed, what's called a guaranteed universal life policy, guaranteed death benefit, guaranteed premium. It's not a cash value type, cash accumulation policy, but that policy, again, in my example, $500,000 of death benefit, you'll have a policy with a rider on it that says if you meet the criteria for claiming on long-term care, you can spend down that $500,000 at $10,000 a month, for instance, 2% of that $500,000, $10,000 savings that you built up. Well, we know that at your passing, that life insurance policy is there to replenish those savings.
You're just swapping assets.
Pretty much, by using the leverage of life insurance.
Right. Can you still buy just a regular long-term care insurance policy? You know, that doesn't. It's not a life insurance policy with a rider.
Yes.
Talk to us about, you know, and I'm not sure. I'm really just trying to educate myself.
Sure.
But depending on where you are, what stage of life you're. So let's start with this. How old is too young?
I was in my mid-40s when I purchased my long-term care insurance policy. So I don't think that's too young. And the idea is, people always ask me, what's the best age? I said, when you're insurable and you're healthy. Right. Because I can't, there's nothing that's going to allow me to predict when the best time for a person to purchase insurance is, because I don't know what's going to change in their health. That would therefore preclude them from getting long-term care insurance.
But if you buy it, I would imagine, because I'm an accountant as well, as you know, and I don't know if our viewers know that, but I would imagine if you buy it at too young of an age, which we can't really define that, your premium is going to be a lot lower.
Premium will be lower. Your health is presumably better.
But you're paying a low premium
for a longer
period of time. And if you wait a period of time. If you wait till you're older, you're paying a higher premium for a shorter period of time.
Well, maybe. I mean, you're paying, again, can you get the insurance if you're older? Can you afford the insurance when you're older? So those are all questions that we don't have answers to.
Right.
With regard to, and I know you want to talk about the standalone long-term care policies, there used to be options on those policies to pay for 10 years and have it guaranteed paid up. Those have gone away because the insurance companies lost their shirts with them. But that would have been ideal in your scenario. There are still situations, and again, you're a CPA, so you could advise people about this, where if in a business situation, and I know this doesn't apply to a lot of people, but if you're younger, that might, right? If you're in a business situation where you can have a corporation pay for that policy as an executive perk, have it deductible to the corporation, not taxable to the executive, and then the executive could have this benefit during his or her working years, so that's an option. My belief still, I have to go back to, you get it when you're young enough and insurable. Because I've been in business for 30 years. I've seen too many times when people have said, I'm going to wait, I'm going to do it later, and then they weren't insurable. Right. Or the rates really went up and then it was not affordable for them. So I just can never advise people that, it's going to be better if you wait 6 years, or something like that. Because it just wouldn't be good advice.
So how do you, going back to my question, and I don't know if this is a different answer for where you are in life, if you're a younger person versus an older person versus a really old person, I don't know if that's even correct in saying.
Superannuated.
More seasoned, I like to say that. How do you present options to those different categories?
I'm first going to get a lot of feedback from them. I'm going to ask them a lot of questions. I'm going to find out where they are financially, and then make a recommendation based on that. And I'll also often talk about a range of options, and then I'll give my recommendation on which one I feel would be more appropriate. That doesn't mean they'll feel it's the most appropriate. A lot of people, it depends on where someone is in life. If they're single and they're on their own, a lot of people like the comfort that having a policy, a long-term care insurance policy, gives them, because the policy will help not only pay for long-term care, but there are often resources that come from the insurance companies that enable them to find home care, nursing home care, and it just gives people a sense of, again, they're independent, they're on their own, but they're not alone because there are resources that are provided along with that policy. So in that case, a standalone policy may make sense. They don't have also perhaps any.
You mean a standalone, not a life insurance?
Correct, right, because they don't have anyone they need to leave a life insurance policy for. In the case of a,
so you just said something that I'd like to just expand upon.
Sure.
If a young couple is already well situated with their life insurance needs, they've done their planning, they've done their estate planning, they've purchased a fair amount of life insurance, maybe they got a combination of term and permanent insurance. They don't need one more dollar of life insurance in their estate. I agree with the leveraging concept, but at a certain point in time, enough is enough, and you might not need it. What do you do in that situation? Is that a standalone long-term care insurance policy?
It may be a standalone policy.
Is it cheaper?
It is cheaper. It is a lower premium, and in that case, sometimes depending on your young couple scenario, I just may look at the amount of permanent life insurance that they have, because again, when we're talking about a long-term care need, we're typically thinking about it when someone is older, and that's where permanent comes in versus term insurance. You're not going to have that term insurance when you're in typically you're not going to have it when you're in your 70s or beyond. Right. Most policies, again, 30 years in business, I've sold policies years ago which were initially 10 or 15 and 20-year term policies. They're all coming up, and people still want to have life insurance. So now buying permanent life insurance when you're in your 60s is a much different proposition than you're in 40s. So I do encourage people to think very seriously about permanent life insurance. By the way, during your working years, during your earning years, you can have a permanent life insurance as a paid up policy. So you could pay into, whether it's a universal life or whole life policy for 10 or 15 or 20 years, and then you're paid up, and then you don't have to worry about it. So that actually works quite well for that young couple potentially, where during their peak earning years they can fund it, and then they don't have to worry about it in their
And
retirement.
they use their cash value for long-term care purposes.
Well, they can just either have a long-term care rider on the policy, or they can just know that that policy is there, so that if they do spend down their assets, there's a death benefit.
So is there any difference between a standalone policy and a life insurance policy with a rider in the care? I shouldn't say the care because that's misleading, but the benefits, the long-term
Just
care
benefit trigger?
Yeah.
Very good question, because with some of the life insurance policies, there's a nuance in the language, and people have to be very, very careful about this nuance. So the long-term care policy, the way you qualify for benefits is when you can no longer perform 2 out of 6 activities of daily living, going from sitting to standing, bathing, dressing yourself, continence, toileting, feeding yourself. When you can't do 2 out of 6 of those, and you have a medical professional certified that your inability to do those things is expected to last at least 90 days or longer, that's how you get on a claim with a long-term care policy. And with many of the life insurance policies, same thing. But with some of the life insurance policies where they're not charging you, actually they call it a chronic illness rider, not a long-term care insurance rider, that expectation of your inability to do those things has to be permanent in nature. That's a big change. And so people have to be very cautious when they are purchasing that permanent life insurance to make sure that the language says 90 days or longer, not permanent, because it's a much higher bar to cross. So
And that's not what a standalone long-term care insurance policy.
It is not. No, a standalone policy is going to have that standard 90 days or longer language, 2 out of 6 activities of daily living. So it is easier to qualify.
So it sounds like to me somebody that's not interested in permanent insurance because they've already gotten their affairs in order. It sounds that's right.
So I do advise people to do that as well.
Yeah, that's good information. Are there any? We talked about the young. At what age is too young? Is there a limit on the other side?
There is. I mean, I can't say for sure what it is these days, but typically once you hit your early 80s, you're not able to purchase a long-term care insurance policy at that point.
Right.
Right now, actually, in this COVID crisis that we're in, I've seen life insurers stop underwriting anyone over 70 years old for life insurance policy. So there is an impact of this virus in that regard also.
And I heard, and again, this is hearsay, but it's getting more, the underwriting is becoming more difficult for these policies as well. Is that accurate?
For long-term care insurance? I'm not so sure it's become more difficult. I mean, that has been a trend over time as the insurers were getting hit with more and more claims. So it's not something new. It's been difficult for a while. Years and years ago, I was actually able to insure someone who already had an MS diagnosis. And that hasn't happened for 20 years.
Right.
Because the insurers realize that they're potentially getting a claim.
Right. So talk about some instances where people just can't get long-term care insurance. Right?
There are a lot of instances. Anyone who has some chronic condition. So anything where there's the expectation that chronic condition could worsen over time. So chronic kidney disease would be an example of that, for instance, where kidney function could be impeded over time and that person could wind up on dialysis. That could be a situation where someone would be precluded from getting long-term care insurance. It could be maybe a recurring cancer type of a situation also.
In this climate here in Westchester County, I spend a lot of time outdoors and in the woods. We know that Lyme's disease is a really big deal.
I just got tested last week.
You did, yeah. Is that a factor for long-term care?
Not necessarily. I mean, if someone presents with an autoimmune disorder due to the Lyme, that's potentially. In and of itself, if someone has a Lyme diagnosis and they're relatively asymptomatic, it should not be an issue. But a lot of times Lyme can create those autoimmune situations. Yeah. And the thing that insurance companies are concerned about most is when something is not specifically diagnosed, not specifically defined, yet someone continues to have symptoms. Then they're worried about it.
Right. So, as great as long-term care insurance sounds, there's a plethora of people out there that just simply either cannot get it because they can't afford it, because it is costly. It's not a cheap proposition. so they cannot afford it. Their physical condition, their health condition may preclude them from being eligible, or they just may not want it. Right?
They may
Some
not
people
want it.
just simply don't want it.
Yeah. There's another nuance, again, in the business market where we're able to do multi-life long-term care insurance. So if we have a business owner is interested, partners interested, key people in the business are interested, we could get maybe 10, 15 people long-term care policies on either a simplified issue underwriting or guaranteed issue underwriting. So people who normally couldn't get long-term care insurance, again, in this special niche, in a business situation, may be able to get it. And again, there might be tax advantages depending upon what kind of corporation.
Yeah, that's interesting. So, in instances where people cannot purchase, they've researched and they've considered long-term care insurance, and for whatever reason, it's not an option on the table, then we need to look at one of those other 4 options.
Yes.
And that's usually where I come in as an elder law attorney, and we talk about Medicaid planning. Because if you don't do your Medicaid planning, you're going to end up privately paying. And so for that, I want to refresh everybody's recollection and bring up the Medicaid trust again, which is a very popular planning technique that you can go on my website and see prior videos about, and I've written many articles and blogs about it. But many people are coming in and doing a Medicaid trust to get themselves eligible for Medicaid later on down the road. It's where we set up this trust and we put your house into the trust, we put financial assets into the trust, and there's a look-back period like you were mentioning before. And for nursing home purposes, there's a 5-year look-back period, and starting October 1st, there's a 2.5-year look-back period for home care purposes, which many people are not even aware of yet. So if you're somebody that is interested in exploring your options with long-term care insurance and you've hit a wall, and for whatever reason it's not a viable option, then we should be talking about Medicaid planning and setting up a trust. And in fact, Chuck and I have worked on situations where, and he was alluding to it before, where people have said, you know what, I'm going to do the long-term, I'm going to do the Medicaid trust. I think long-term care insurance, it's expensive. That's usually what comes up. So I really want to do the Medicaid trust and get myself eligible for Medicaid. But I'm also concerned about, because of my age and the history of my family, that the 5 years, I want to make sure I'm still covered. And what we've done in the past is we've had the best of both worlds. I've created a Medicaid trust, and Chuck will sell you a long-term care insurance policy. He was referencing before the single premium payment, where somebody can take $200,000 of lazy money, put it into the policy, you get a policy, and after the 5 years has elapsed, you now know that you're good with the trust that I created, and you can exercise your option under the long-term care insurance policy to take back your premium and cancel the policy. So it's really the best of both worlds. I've had plenty of people do that, where they cover themselves for that 5-year period. God forbid something happens during that 5-year period, you're not eligible for Medicaid, but you've got long-term care insurance. And you'll be happy that you paid that premium in a one lump sum fashion. And to be able to get it back, that's
It's a belt and suspenders.
It's really belt and suspenders. So, we've done that for people that are a little bit older and are just unsure as to what the next 5 years might have in store for them. And it's a really good planning technique that, quite frankly, Chuck, I don't really see people implementing this on a regular basis,
They have to want to make sure that period is protected.
Yeah. It's something that I think should, so don't get me wrong. I don't see it on a regular basis, but it's only because I think people are not aware of it. I think it should be being implemented on a more regular basis.
And it gives them the comfort of knowing they don't have to pay forever.
I mean, it's like having 2 pillows under your head instead of 1, right? So I think that was very informative. Chuck is somebody that is very experienced in this area. Why don't you just tell people just a little bit about your practice, so that way if they want to call you, how do they find you?
Yeah.
And Chuck also has a health insurance component to his practice. So just tell everybody a little bit about what they can call you for. It's not just long-term care insurance, and give them your information. That way they can come find you.
Thank you. So yes, Charles Newman is my formal name. So you can find me at charlesnewman.com. Our business is in Peekskill. It's called Charles Newman Company. And you can email me at chuck@charlesnewman.com. So I assist people both with long-term care, dental, life, long-term, short-term disability, and then voluntary benefits that employees can pay for through payroll deduction.
That's right. Good. Well, Chuck, it's great having you here today.
Thank you. Appreciate
We
the
haven't
time.
seen each other in quite a while.
It's been really nice to put on a jacket for the first time.
I'm looking forward to spending some time on your boat this summer if we're able to.
Socially distanced summer.
You could tie me on a raft and I can follow you in the back. But thank you for joining us. And again, my name is Salvatore Di Costanzo. You can reach me at 914-925-1010 or at my website, which is Plan Today for Tomorrow, all spelled out. And we're going to take a little bit of a break over the next couple of weeks with the 4th of July holiday coming and resume after that. And I think there are a couple of questions that we might want to answer. No? No questions. So again, thank you for tuning in. I know a lot of people are watching this. Chuck, a lot of people watch this after the fact.
Sure.
Right? So please like us on Facebook if you enjoy these, so that way we get more people watching. But then we put this on our website, and I invite you to do the same if that's something that you want to do. But I'm finding that people are coming back at this after the fact, later on, and they're watching these videos. So again, thank you. Enjoy the 4th of July weekend next week, and take care.
Thanks, Sal.